Hello and welcome everyone. The market is giving us surprises every day, either because of inflation concerns or global uncertainty. The one thing we have learned is that the uncertainty is the only constant thing. And therefore, today we are here to discuss how should an investor react in the dynamic market. So we have Mr. Shreyash Devalkar, Head of Equity, and Mr. Devang Shah, Head of Fixed Income with us. So welcome both of you. So Devang, my first question to you. We have seen all the asset class has gone through different phases. So be it equity, which has went to all-time high and has come down again. Be it debt, which has provided a lot of portfolio stability, especially during the rate cut cycle, and gold and silver shined. So what should an investor do in this kind of scenario when he is confused at what to look at?
Thanks, Shika. So you rightly highlighted, I think, all the things. Like today, there's a lot of uncertainty, and you use the word about concerns which investor would have, that all-time high equity, significantly high gold prices, and probably at significantly lower on the interest rate cycle. What should investors do? I think at all point of time, what is important for an investor is that he needs to understand what are the themes, because there are themes which impacts asset class, and that is where if you choose the right asset class, it helps you to generate stable performance and probably look at better returns. So what investors should focus on is the underlying themes. It's actually what is shown on the screen also at this point of time. If we look across at the three time frames over the last 15 years, we have had different themes working across, and which has led to massive performance or massive outcomes on various asset class. If you look at 2008 to 2013 period, actually and prior to that, the general thought process there was economy was doing very, very well and everything was quite good. But 2008 to 2013 was a complete risk-off mode. And that risk-off, if you look across at gold returns, I think they have come out to be the significantly best performing asset class. Similar time frame, if you pick up from 2014 to 19, a person would have invested and looked at gold returns in 2008 to 13, and then look at, okay, gold is it is better to time market and probably get into the momentum trade of gold. But if you look at gold has not performed so well. 2014 to 19, if you pick up, actually, it was zero interest rate cycle, you have quantitative tightening, lower inflation, and somewhere down the line, the entire theme of European crisis, which actually led to bonds outperforming. So I think the themes led to asset class performance. And the last cycle, which is 2020, I think the biggest question which investors had at that point of time was uncertainty and probably fear in their mind, because the pandemic was significantly a worrisome time frame. But if you look at the asset class, and you would never believe so that after the COVID environment, equity would have done so good. But I think the themes like somewhere down the line, China +1, themes like fiscal expansion, themes like significant fall in inflation has actually led to equity coming out as a winner in this category. So what I believe so is that somewhere down the line, if you capture the right theme at the right point of time, if you work on the right themes and you select the right asset class, it leads to significantly better outcome for investors.
So, like Devang, you highlighted that different themes work out at a different time. And if I look at the market today, each asset class is quite confusing because we see headwinds as well as the tailwinds. So, Shreyash, what will you suggest an investor who is making a decision of where to invest?
Indian GDP growth is one of the fastest growing. Indian fiscal consolidation is happening. And in India, what we have observed is the health of corporate has improved a lot, because of which Indian equity should be core of your investment.
Just to add to Shreyash's point, I think probably as you rightly highlighted, and the previous theme also explained that you should have a diversification among various asset classes. Today, there are equally good number of tailwinds and headwinds for bonds and precious metals also. So I'll start with bonds first. So I think from a perspective on market still, I think inflation is still falling, okay, because thanks to China is exporting disinflation everywhere. So somewhere down the line, inflation is going down. Secondly, central banks are still in the rate cut mode. So there are positives for rates. But at the same point of time, if you look at debt to GDP, like debt to GDP is ballooned for US, it started to balloon for a lot of global economies. Look at France yields, look at Japanese yields. So they've all significantly risen. So our perspective at this point of time is that though there are some positives for bond markets, there are some kind of negatives, specifically fiscal expansion and rising debt to GDP is a worry. Now, specifically coming to the other important theme which worked last year was precious metals, and gold and silver have given significantly good returns over the last 12 months. We believe one is, yes, there has been some tailwinds on central bank buying, a significant de-dollarization theme, but at the same point of time now supply started to increase for both gold and silver. We started seeing increase, and if I look at year-on-year central bank purchases, they are not increasing at such a fast pace, which is getting reflected into the returns. So our view is, yes, definitely there are positives for both the asset classes, but at the same point of time there are headwinds, and hence a diversification as well as understanding what will be important themes going ahead, which will have an impact on the asset classes, is very important at this point of time.
So, Devang and Shesh, I think you covered a lot on the themes which happened in the history and which are the current themes. But if we think of an investor, I think the major questions which comes in everyone's mind is, should I book a profit right now? Or if I book a profit, where's the next step? Where should I invest? So, Shesh, what will be your advice to the investors?
Allocation to asset classes is most important. The same question comes when it comes to large versus mid versus small. Same question comes when it comes to multiple asset classes, when to buy, when to sell. If you notice, since 2007 till date, almost in all the years, if you take the best performing asset class, then in 5 years, or in 5 years out of this 2007 to 2024, you will observe that Indian equity and silver has been the best performing. In 3 years, it has been US equity and US bond. And when it comes to Indian bond and Chinese equity, they have been outperformer only in 1 year, the best performers. So if you look at it in a different way, then currently silver is giving a lot of returns. In 2020, it was flat. So this rotation keep on happening. It's very difficult for an investor to shift from one to other. There are multiple implications, including tax to others. So hence, diversification in all the asset classes is important, and changing at margin is what is the solution to this.
Sure, Devang, like Shesh highlighted that no asset class has done well in any of the years. So what is the solution which you will give it to the investor?
See, my understanding is how we should look at it is that if, and he spoke about that disciplined asset allocation actually has come out to be a better solution than probably just investing in one asset class at all point of time, okay? And that has been proven by data. If you look across also, if you have done a simulation across and you have hold a simulation of 40% equity, 30% bonds and 30% gold, or vice versa, 30 debt, equity, gold, and if you have looked at the last 15-17 years of how the asset class has performed, actually it comes out that a diversified, disciplined asset allocation gives you kind of significant stability in your returns and with significantly lower drawdowns. So I believe so, I completely agree with Shreyas here, that if we follow a disciplined asset allocation model, I think that is a good solution for clients from a medium-term investment perspective.
So, Devang, while designing the FundX's multi-asset active fund of fund, what were your thoughts regarding it, and why you have opted for a fund of fund structure?
See, Shikha, we all know now fund of fund structures are very popular, and somewhere down the line they have been there in the system for long. But there's significant benefits for investors, as I think Shreyas alluded previously. If investors actually want to switch across, because we all explained that there's no particular theme which works at all point of times, okay? But if an investor wants to switch from, for example, Indian equities to global equities, vice versa, if he wants to switch from large cap, mid cap to small cap, or in debt funds, he wants to switch from a short-term fund to long funds. I think there's a lot of implications on the client or investor. Why so? Because he'll have to pay exit loads, he'll have to pay taxation on different perspectives. I think the FOF structure gives a complete flexibility to the fund manager as well as to the investor to maneuver his asset allocation and without implications to the investor. So that is all, if you ask me, is the significant benefit to the investor, that he can play across various themes without significantly getting impacted on the taxation side.
So I think one more advantage is both of you managing this fund and which bring expertise of both fixed income and equities together. But how will you both decide on the asset allocation and selection of the fund?
So, Shika, we have been running an asset allocation model for now various years, and we have back tested this model for now from 2018. And I think that model would be a guiding factor to decide the asset allocation among equities, debt, gold. There are various parameters which we have been focusing on in the internal model. There is also I would say the supervising factor, which is an internal committee which we have created, where all of us will be there, the head equity, head debt, will ensure that the supervising factor from the internal committee as well as the asset allocation model will be the guiding factor to decide the allocation for this fund.
And how about the underlying fund selection?
In case of Indian equity, as usual, we normally what we do is 80% is core equity, 20% is tactical exposure. So that core equity can be chosen from the core large, mid, small cap funds. Then there can be funds which are some thematic funds, as well as some other funds where we don't have a broad base. We can buy a narrow thematic fund also. So we can have a bunch of funds structure there.
And how about in fixed income?
So fixed income will be all macro driven. So as I told you, the model also takes into factor a lot of consideration on what are the macro parameters at this point of time, which is growth, inflation, all the dynamics, which will tell us at this point in time where are we on the interest rate cycle. If we are bullish on the interest rate cycle, we'll be looking at more adding duration funds or gilt funds is a simple solution for that. If we are more bearish on the interest rate cycle, then probably we will be going for an accrual theme. At this point of time, any which ways, our view has been on the fixed income side that we believe we are at the fag end of the cycle, and accrual will be the product which we like and probably add at this point of time on the fixed income side.
And how will you play a core and tactical strategies? Will everything be like a buy and hold strategy, or you will play some tactical calls there, especially when it comes to gold and silver, which are the shining asset class?
See, as on the debt side, as I said, as a fund house, we have always followed this 80-20 principle of 80% of our allocation always being core, which is more medium term on the thought process, which is more macro driven, and what the fundamentals are telling us. 20% can be, as Shreyas highlighted at this point of time, like certain asset classes which will looking good, offshore equities looking good. Last year we had this entire theme about precious metal doing very, very good. So we can significantly rejig a portion of our allocations there to capture those tactical themes. But 80% would be core allocation to core macro fundamental principles.
So Shreyas, since we have multiple asset classes here, is it risky to invest in this fund, or what kind of investor should look at this fund?
If you look at the individual asset classes in this fund, so there is a gold, there is silver, Indian equity, all of them are highly volatile. And that's why on the riskometer basis, this comes as a very high risky product. But from the investor perspective, investor also look at the convenience part of it. You are going to get exposure to all these asset classes.
Just to add to Shreyas' point, I think probably the fund is there for everyone. All retail investors who at this point of time are significantly confused and uncertain about where to allocate. You are actually outsourcing your investment decision to an institution-based, supervised asset allocation model, and somewhere down the line an internal committee which supervises all the allocations and decisions. So my understanding is this is a non-specified mutual fund category where the investment horizon should be for more than 2 years, so that the tax efficiency kicks in for the investor. And definitely a retail investor who is uncertain at this point of time should be looking at this fund from a medium-term asset allocation and an investment horizon.
So thank you so much for the insights, Shreyas and Devang. To sum up, Axis Multi Asset Active Fund of Fund is a one-stop professionally managed tax-efficient solution, and a dual fund manager approach ensure that the perspective of all asset classes are considered. The NFO starts from 21st November and ends on 5th December.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.